Hello, welcome back. So Google reported its earnings and the stock is up about 8% almost right now in the after hours market, $132. So in this video, we're going to be taking a look at what happened first and then examine the company's financials a little bit just to see whether it is still a buy. Alphabet reports better than expected quarterly results driven by growth in cloud, which is important, and you will see here that this was pretty impressive here. Now, Alphabet's second quarter revenue rose 7% from the year prior. Remember, that's the second quarter revenue, it's not the total. So 7% is not bad at all. Cloud revenue climbed 28%, which is fairly impressive here for the company. And also, the company said that Ruth Porat is leaving the CFO role and is going to become a president and chief investment officer. So let's see what happened here with exact numbers. Earnings 144 per share, that's a dollar versus 134 a share. This is substantial actually, significantly better than expected, frankly. And the revenue of 74.6 versus 72.82 also significantly better than expected. And looking at these numbers, it makes a ton of sense why we are looking at an 8% rise right now. YouTube ads 7.67 billion versus 7.43. We do know that YouTube ads have fallen, generally speaking, quite significantly for a lot of YouTubers. Yet the expectations were even lower than what the company achieved. So this is basically good news for the stock. Google Cloud 8 billion versus 7.87. Again, was a pretty significant bit, and the traffic acquisition costs of 12.54 billion versus 12.37. Now, generally speaking, this is not a good thing for the company if it's higher, because it means that the company is spending more money in order to attract customers, basically, and they're spending more in order to make money is the thing. So traffic acquisition cost is what we call that. Now, for the fourth straight quarter, Google's parent company reported growth in the single digits as it records with a pullback in digital ad spending, is what we said earlier, reflecting concerns about the economy. Is a thing that we have known for a while now, and it's one of the reasons why the company stock price hasn't been achieving tremendous growth in the past few quarters or a couple of years or so, even. Now, Google's ad revenue came in at 58 billion, up from 56 billion last year. And YouTube ads came in above analyst expectations, as we saw a little bit earlier. And again, the company is going to have Ruth Porat leave the position of the company's finance chief, and he's going to be going for a different position, still staying with the company. Interesting here, and we want to be taking a little bit of a look at the company's financials now, just to see whether it is still a buy. Let's take a little bit of a closer look at that one. Now, as I mentioned in previous videos, I have bought Alphabet near $118, so I'm up quite nicely at the moment, and a lot of people have actually bought it at even cheaper prices. Now, if we take it back like 6 months, it even reached like $80 here. So you had fantastic opportunities buying this company when it was at its even lower levels. Now, if you take a look at the 5-year chart, you will see that we are approaching the 5 years high here for the company. So this may not be too cheap, frankly. You can kind of see it here as an overall picture for Google being, getting higher and higher and doing amazingly well through the years. So this is fantastic. Now, this pullback, obviously, again, it has been a fantastic opportunity. But what about now as we are pulling upwards? Is it a good opportunity? And remember, we're sitting at 132 right now. We are not here anymore. So we're approaching, actually, we're surpassing the 1-year high when the market opens tomorrow. That's just something to notice. Yet, the PRS of the company, and again, I mentioned this in the previous video I made, obviously, you would love to have bought it earlier, for sure. But if you're buying maybe a small lot, maybe $5,000 or something of that sort, you may be okay just starting to accumulate a little bit if the price allows for it. Because, a difference of like $10, while significant for sure, is not going to break the bank for you. However, we want to be making sure that it's a good price, and it's going to be a good price at $132 is also a thing. And the company is also buying back shares, which is great, because even if you buy at a little bit of a more expensive price today, the company is buying back shares, and your shares are going to be worth more intrinsically as well, and practically speaking too, through the years. And the company again achieving fantastic growth through the last decade. We know about this one. You can kind of see it here. Tremendous growth for the company. Net income, free cash flow, pretty much everything. Net income has dropped a little bit. We do know about these things. Again, it has been a little bit of a drawback what happened during the COVID era. But now the companies are kind of coming back, and you will be seeing them more than likely continue their path towards growth. And again, fantastic margins here for the company. Again, dropping a little bit from what they used to be at some point, yet still at a very, very respectable level of like 21% almost here. So pretty nice for the company. And we have talked about the company's statements in the past, and they're looking amazing. It's actually insane to see a company of this sort. Like, picture this, right? Starting from 59 billion just in 2013 and growing to 282 billion. Imagine that, right? From like 13 to 2022, growing that much in revenue. This is tremendous. And the same amazing growth for net income, 13 billion to 60 billion. And obviously, investors salivate over these types of growth here. Tremendous, just tremendous growth for the company. And they actually used to be even 76 at some point. I remember we had a year where things were actually going south. And you can kind of see it here that their net income hasn't been the best last year, but still pretty respectable as well. So again, it's a company that you would definitely salivate and you would love to have hold through like 2013 and on. Because, if you take a look at their free cash flow, 11 billion to 60 billion, that's nothing to sneeze at. That's amazing. And will they continue doing that? More than likely, yes. I mean, you cannot expect this kind of tremendous growth because you are looking at much lower numbers here, like a net income of 13 billion. Now we are looking at a net income of 60 billion, and it is growing and growing and growing. So it's not easy to continue achieving these kinds of results through the years, right? So as the company becomes bigger and they're making more revenue, more net income, it's going to be tougher to grow. The growth levels are going to be less through the years. And it's very, very typical for behemoths, for companies that are huge. Now, I want to be taking a look, obviously, at our stock evaluator, which will tell us the story behind the stock price. And again, you will see that last year, for instance, the growth was like 10%, and the revenue growth, the 5-year average has been 21%. This handy little table that we have here in our tool tells you the story. It's still fantastic growth, frankly, for the company. Absolutely amazing growth. Yet, you cannot actually do projections using these kinds of numbers like 40%. You kind of want to go lower. And obviously, if you have access to our tool here, and all our patrons have access to our tool, if you are interested, you can become one by visiting the link in the description box below this video. But you want to be trying some different values and see what is your risk tolerance here. So some people would be okay with something like 7% for revenue growth. Others would think something like 12%, and others could even try 20%. So in this video, I wanted to try all these different scenarios, these 3 different scenarios, which are very, very different from each other. And what I'm going to do is I'm going to be using the same net income margin, the same free cash flow margin for this video. And again, you can see my other projections using Google here with other numbers in other previous videos that I've made in the past. But let's just try something like this in this video. So I'm going to go with like 21%, which is basically the lowest of the net income margins that the company has been achieving through the past 5 years. The average has been 23, as you'll see. But last year was like 21.2. And the free cash flow margin that I'm going to be using, again, you can kind of see here, it's 90 to 100. So I'm going to go 95. And I'm going to stick with it throughout all these scenarios here. Just because I want you to see the difference between the different revenue growths here for the company, which is tremendous as expected, as you would expect. And the annual return of 13%. And you can kind of see here why growth matters a ton, obviously. And you will see that the different growth values tremendously affect the current price to buy for the company, with a high of 133.7. The price that it is right now is what we're looking at. And as you can understand, this assumes a 20% revenue growth. So the company is getting a little bit more expensive here in regards to their free cash flow. But as I've mentioned in the past, there are other important things about such a company, super important things. The fact that they are buying back shares, they don't have debt, they have fantastic margins, they are growing at an amazing pace for this kind of, for how large they are, basically. So even a price of 132 that the company is going to be tomorrow is really not that expensive. It's more expensive than you would like, and you could have bought in the past, of course. But it's not a no. I wouldn't say it's a hard no. It's an expensive one. It's getting a little bit of an expensive one, but not as expensive as other companies. For example, I think, for instance, Microsoft is significantly more expensive, or Nvidia, for instance, is also significantly more expensive, or VMware, all these companies. So Google here is probably one of the best ones in terms of how cheap or expensive it is, again, compared to all the other big players. And we did have the opportunity of buying at 80 potentially, but if you haven't, even right now, maybe a small lot even wouldn't be a terrible idea, frankly. But thank you for watching, guys. I'll see you in the next video, and do tell me whether you bought Google or not. Thanks for watching. Bye bye.